Hello, and welcome back. In this video, we're gonna be taking a look at this new IPO, the Arm IPO, that debuted a few days ago. And a lot of people are potentially wondering whether this is an interesting buy right now. Now, in the previous videos that I've made, and many times, multiple times, I've actually told you how it's, generally speaking, a good idea to wait a little bit, get some publicly available financial information. Because when the company is not an IPO, it's a private company before that, and this means that there is not the same level of scrutiny in their reporting, in their results reporting, in their financial reporting. And so, even though we do have some numbers, they are not as robust and reliable as they would be when we get the public statements. And we don't have any at the moment because obviously this is a very, very new IPO. However, we do have some information about the company's financials based on the past, and we're going to examine that. And again, this is private information. Some of it may not be super precise, but still they will give us an idea of whether this is a good buy or not. Now, ARM, as you'll see here, currently sitting at about 50, let me find it here, $55, and it's down 5% today. And again, we're going to be taking a little bit of a look at the private information that we have for the company. And you will see, obviously, the company, a very well known semiconductors company, that had subpar results last quarter. And I have the finer details here for which we're going to talk about. And the forecasts for the company is about a 6.8% compound annual growth rate to approximately $246 billion by the end of the calendar year. That is ending 2025. Remember, this is the forecast. And as you'll see, the company actually was down 1% over the previous year's quarter, is what I told you earlier. Revenues of about $2.7 billion, while a small revenue decline is not great in absolute terms, as the article is pointing out, is not a bad result, and indeed it's not a bad result. Among all these companies like AMD and Intel, for example, that have dropped and have had declines of revenue of about like almost 20% or 15%. So what is happening with ARM right now is, generally speaking, not terrible. And they have pretty high margins as well, like their net margin is attractive at around 20%. Again, remember, private information, this is not public. Still, it's probably close to accurate. And we're going to examine that in a little bit more detail as we're taking a look at it now. So, 1 billion shares is what we're having right now. Obviously, we won't be having any data here in regards to the outstanding shares because new IPO, not much movement. But we do see, and it's interesting to see that the trailing PE is sitting at 140, which is super high. And we will examine why this is happening. If we take a look at our income statement here, and again, private ones, these are not public statements, you will see that the company did 2.7 billion of revenue in fiscal year 2023. And among these $2.7 billion, if you divide this if you divide the net income that they generated, which is 500 million, divide this with the amount of shares, remember about 1 billion shares is what we had, you will get a net EPS which is about $0.5. And the last 12 months is actually even less than that, it's 0.39. So what I'm going to do is I'm gonna be opening up our calculator here, and you will see why the PE is more than 100. The current price, let's just say it's 55, just to have it a little bit, a little bit easier for the calculation. You will see that what we need to do is 55, the price of the stock today, and divide it with the income per share. Because this is how much we're getting out of one share, this is $0.50, and this is how much we're paying for a share, $55. So if we do the division, 0.51 in this case, we will see, oops, that wasn't correct. Give me a second. Let's do it again. I pressed something incorrectly, I think. 55 divided by 0.51, then we're getting 107.8. It was the trailing P. And if we do 55 divided by 0.39, which is the last 12 months, pretty much, we're going to be getting an even higher value, 141, which is closer to the actual PE right now. So as you can see and as you can understand, the company's stock price is actually fairly expensive right now. What would be a less expensive or a more attractive price? Let's just say that the stock was like 20. So if we do, if the price of the stock was like $20 divided by 0.39, we're getting about 51, and it's probably still expensive. Now, obviously, we would have to have a full discounted cash flow model. That would be best in order to evaluate what kind of cash flow the company generates, because other factors come into play as well. But in my view, probably something around 15, maybe $10 to $15 would be interesting for this kind of company. As it is right now, it looks super expensive to me. And maybe 20 for some people, it is expensive, but it would be much, much more interesting than what it is right now. But this is what we're seeing so far for the company. And in regards to their cash flow, again, you will see that the net income over here becomes cash flow for the company. And the actual free cash flow that the company generates is about $675 million, which is very close to the net income, kind of expected. And again, similarly, we would probably want to see something near the $15 to $20 range for it to make a little bit more sense. In terms of the profitability, again, we have little information here because obviously this is not publicly available, so some things are missing. But you will see what we talked about earlier. The margins are about 20%, with the gross margins very high as well. And this is interesting, and pretty high margins too. So that's something that we like to see, and it would come into play when deciding whether to buy the stock, because higher margins make for a much, much more attractive potential for the company. A more attractive buy is what we would be having with higher margins. And yeah, 20% is definitely pretty attractive. If we take a look at the solvency as well, you will see that the company has very little debt, and kind of to be expected as well, but nice to see. Not much debt compared to the equity that the company generates. And in regards to their equity, you will see that the total equity is sitting at about 4.2 billion right now, is what we're having, and has been growing through the years pretty nicely, very solidly. And generally speaking, what I'm seeing in regards to the financials of the company is a steady company that keeps doing better and better. Yet their growth hasn't been tremendous recently, apart from like 2022, where it grew quite a lot, quite substantially from 2021. We could potentially be expecting this to continue through the years, but we have to pay a handsome fee right now, and that's way, way more than what I would like to pay, frankly. And the thing about IPOs, and this happens a ton, is they tend to be really, really unstable. So they tend to go up and down quite significantly. So I'd like to wait for it a little bit, just wait a few quarters, have it stabilize a little bit. Then I can analyze with my tool as well, create discounted cash flow models that would make much more sense, because we're going to be having publicly available information then. And we do know that the values are going to be precise. And the way I would play this right now is just wait it out, see what is going to be happening with the public information, with the public data. It's worthwhile to at least take a look at what the company has been doing when it was private, just to get an idea, and potentially even shortlist it, have it in a watch list, and see whether it's an interesting buy later on. But right now, I would probably not be touching this one. It's probably one to avoid for a little while. And it's going to be talked about quite significantly as well. Like if you take a look at the stock tweets, for instance, there's going to be a lot of discussions and a lot of volatility here. In the first few days of an IPO, there tends to be significant volatility. So you'll see that we already had like 69 and 51. And what happens, and what tends to happen a lot, is that you would be getting days of like minus 10% or minus 15%, and then you could be getting days of plus 20% or plus 30%. Like it can be that unstable. So entering right now, unless the stock is super cheap, it's probably not advisable, because you could end up riding a roller coaster. It could also take you down even significantly in some situations, especially if the overall market is not flying. You can actually drop quite significantly. So this is why I like to wait, and this is why I don't really want to be one of the first people to be entering companies of that sort that are IPOs. But again, interesting to know about ARM. Interesting to see what the sentiment is, which right now seems to be overall positive. But again, this can change rather quickly and go up and down quite significantly. You could be having very, very red days and very, very green days, and that's exactly what I'm expecting to happen. So for now, I will be waiting on it and see what is going to be happening in the probably next few months, like the first 2 or 3 quarters, we would definitely revisit this one, and it would make a lot more sense to. So thank you for watching this one, and I'll see you very very soon, as I'm coming back from my vacation in about a week from now, and there's going to be a lot more videos upcoming coming your way. Thanks for watching. I'll see you soon. Bye bye.